Michelle Schneider, Chief Strategist at Market Gauge, joins us for more now. Michelle, let's talk that Fed rate cut there. 25 basis points expected, but there were pretty strong calls going into this meeting that the Fed should actually stand pat, especially with, latest data showing that the Fed didn't really need to move. And we also saw reports that Cleveland Fed President Beth Hammack saying that, rather she dissented as well. So your thoughts on the Fed's move to cut again and its indication of fewer reductions next year?
Well, it would have been interesting had they decided to hold pat and were more dovish for next year. We might have had a different reaction, but at this point now, that's, hindsight 2020. What was so interesting is that the market anticipated there was a 97% gauge that they were going to actually do the cut that they did today. So it was expected. What was unexpected was this tremendous sell-off, and it was actually the largest sell-off post FOMC since March 2020. And if you recall, in March 2020, that was the start of COVID and a massive recession. So, of course, that's now making me question, with this type of sell-off, was it just what he said about only 2 cuts next year, or that he's going to move the bar on inflation from 2.1% target at the end of 2025 to 2.5%? So he's sort of conceding to a stickier inflation that he can even deal with. It's hard to know. Or is there some other crisis around the corner that we cannot anticipate? So I think that's going to be the big question, number one. And number two is it certainly resets the optimism of December, the Santa rally that so many people were positioned for. And now with this sell-off that we've had today, over 1,000 points in the Dow, we have some real questionable looking charts, particularly the S&P 500, which was so strong, broke down under the 50-day moving average today. And the small caps in the transportation, those sectors were already underperforming.
Yeah, I just want to follow up on that. I think you talked about the surprise there, or rather what was unexpected was that sell-off that we saw, especially in the Dow as well, 1,100 points there. I like to look at that more specifically because it was already declining in the past 10, 11 sessions. In fact, it's headed for the 11th straight losing session. And if we just look at the makeup of the Dow, it's, filled mainly by sort of old economy names. What is it telling you that that's not doing too well? Does it also have to do with, sort of the Trump trade waning?
Well, there's a couple of things. Number one is United Healthcare is in the Dow. And of course, that went down after he was killed, the CEO of it. So that was part of it. But I think that was not only I think you're right. I think the question about the Trump and the whole optimism, euphoria, if you will, that happened right after the election started to wane as more and more investors are starting to realize that a lot of what he plans to do, is not necessarily as clear as one would like, particularly from an investor standpoint. What is he really doing with tariffs? How much deregulation? Will he be able to really get corporate taxes in things made in America down to 15%? Will he be able to actually solve some of these geopolitical concerns? The market actually went right to the growth stocks, which are sort of immune, almost a flight to safety, as people started to realize that maybe some of these claims were a bit lofty and could not even be accomplished right away. And then I think that sort of fed on itself. So the first area to decline in the market over the last week was the transportation sector. So it was already projecting disappointment in how robust we can get goods and services moving in the United States based on the plan to try to grow us economically by these policies that Trump want to enact. So now we have to wait and see. He's going to have to really pull these off, I think, or we're going to start off with a rough 2025.
Yeah, and speaking of 2025, I want to know what else you think will feature big next year. I mean, monetary policy is definitely going to be a big thing, but what else is on your cards?
Well, because of monetary policy, even before we knew what was going to happen today, and as I mentioned, we saw the growth stocks moving up. Everything fell today because today was just a let's get to the exits. But when things settle down, AI and quantum computing AI are certainly growing fields. And companies like NVIDIA actually went green for a second before the close because they're not really going to be so concerned about interest rates or even economic growth from the inside sectors, you know, the normal ways that we would measure economic growth manufacturing in the U.S. So I think that can do well. I mean, NVIDIA can continue to sell enough chips. They've got chips sold before they're even made. And then some of the other companies that started to look good as a result of the software of AI, like Alphabet or Google, for example, or Broadcom, I think they can do well. But I'm looking at what can do well regardless of what happens. I mean, that to me is always going to be a unique situation. And I think the consumer is shifting. We already saw that in retail sales this week, not eating out as much, still online shopping, buying cars. So that brings me to two other trends. I do believe that the EV space will actually do well, not just Tesla, but particularly cars made in the United States. And two is I think the thin consumer, the diet drugs, and the domino effect of that with beauty, skincare, exercise, health, supplements, those kind of things. We're already seeing some good numbers in terms of things like Ulta Beauty and AbbVie Pharmaceuticals, which does Botox, iPar, which is a perfume company, Urban, which sells athletic wear. The trends are starting to move that way. So those are two real big areas we'll be looking at on top of AI for 2025.
All right, Michelle, really great to have you on. Michelle Schneider there, our Chief Strategist at Market Gauge.